Coming up today, stocks surge higher again with the biggest volatility crush in history. Is this like the mid-90s? Or are we getting to the end of a bull trap? More stocks big investors are buying. Walmart surges to new all-time highs. WHO declares a global health emergency. Retail sales surge. Jobless claims fall. And Goldman Sachs gets into Bitcoin. It's another big day, guys. Let's get it. And just like that, starting to feel like Groundhog Day here, isn't it? Market squeezing higher again. Looks like we are doing that V-shaped recovery. And my very best case scenario in the S&P 500 pullback could be playing out. And looks like my S&P 500 oscillator indicator nailed the low just like it did back in April. Never feels like it when you get there. And that maximum fear moment we had last Monday morning. And just look at the market color, awash with green in all the growth sectors. Red where all the bulls want to see it. Volatility, bond yields, dollar index and inflation expectations. Anything really not participating in this everything rally is Bitcoin. And I'll get back to that a bit later on. But all stock sectors and other risk-on measures are green across the board. So surely we're not going back to new all-time highs anytime soon, right? And you can just imagine all those people that loaded into put options last Monday morning on that peak fear. So a lot of those puts would be down 80-90% by now. Not only the huge sharp move in the Delta, but just the absolute crush in the VIX, which has surprised a lot of people, myself included. We've literally retraced 50 points from last Monday's high in just 8 sessions. Something I didn't even think was possible last Monday. I was quite confident we'd seen the high in the VIX for the year, but I was not expecting to see a 15 handle the following Thursday. And that's because we just broke a new record and by quite a large margin as well. We'd already broken the 5-day, 6-day, 7-day, and now we've just done that 8-day record for the biggest percentage crush in the VIX. We closed last Monday at 38.5. Here we are today at 15.2. That's a 60% drop in 8 trading sessions. Looking back in history, the last 19 times, we've had a big VIX crush over 8 trading sessions. All but one of them, we were higher a year later. Maximum fear, usually a pretty good starting point to measure returns from. But like I showed you in previous data points, in the short term, can get a little muddy in the first month, can continue to see a little sideways up and down. However, this time, it's been a pretty sharp V-shaped recovery. And here's another visualization just to show what an absolute abnormality this VIX crush has been. Looking back in history at VIX spikes, when the VIX has risen to close above 35, as it did last Monday, the index has taken on average 170 trading sessions before returning to 17.6. Its long-term median reading. And in fact, in some instances, it's taken over 200 trading days, even 300 trading days. We just did it in 8. Another visualization of the VIX term structure using VIX futures. Days to expiration. Here's Monday in the green. Really popped up the top. We got that backwardation where the second month, third month, fourth month trade at lower values. Then you can see last Tuesday, last Wednesday, last Thursday, and then Friday and this week. It's just absolutely flattened out. And in fact, we're already back to a normal state of contango. From right up the front on the 1 day, then we've got the 9-day higher, the normal 30-day higher, along with the 3-month and 6-month. So once again, volatility market is back to normal state, pricing in higher volatility out. And like I'd been pointing out to you guys the last couple of days, what was really catching my eye was also the massive crush in volatility risk premium. That's the difference between the VIX index and realized volatility. So you can see even there today, the market's still moving around at an annualized rate of 21%. However, the VIX index, which is a representation of the average implied volatility of S&P 500 index options over the next month, they're implying stock movement at an annualized rate of 15%, creates a negative VRP of 5.7. And like I've pointed out to you guys in the past, whenever we see that big crush in VRP, a lot of the time, good tailwind for stocks. Option dealers very good at pricing the future with volatility. They're happy to sell premium 5 points below where we're actually trading in terms of volatility. They're forecasting lower volatility around the corner. However, I'd say a big part of this pop is we just got a string of bad news and sentiment coming into last week, and now we've kind of flipped and we've got a number of good news, especially today on retail sales, the jobs market, Walmart earnings, amongst other positive developments. So truly impressive, this bounce back. NASDAQ back above its 50-day. Russell 2000 still not quite there, even though it led the indices higher today, 2.5%. Pretty nice moves up on volume Brett, starting to get back up there. Same with actual Brett, stocks above their 50-day average. And even though 52-week highs outpaced new lows, still a bit more work to do there. And it's also good to see the 10-year government bond yield stabilizing in this support zone as well, putting in a little bullish divergence on my DSI indicator. Doing even better, high yield bonds officially breaking out to a new 52-week high today. That is a good sign for risk-on sentiment. And stick with me today because I'll come back to Bitcoin and the commodity markets. First, just getting back to the stock market. Looking at the 6-day chain we've seen in tech stocks. Bursting up over 11%. Last time we saw that was in late 2022 and in COVID, March 2020. You can see these momentum bursts. And when they occur after sharp lows or above their long-term averages, quite often it's a bullish sign. Big rush of money coming back into the market. I think it may have just got a bit carried away with the Japanese yen, recession fears, etc. As I've been saying, corporate earnings are accelerating. US economy is still growing. And even though there's signs that we could be on the verge of a recession, certainly possible, Fed's set to cut rates. That's more often than not associated with contractions in the economy. However, we also saw the Fed cut rates in the mid-90s, multiple times. A lot of people thought even back in 95 and 96, stocks were way overvalued. Then Fed Chairman Alan Greenspan famously quoted, "The stock market has been irrationally exuberant. In 1996, stocks went on to rally for almost another 5 years. In fact, the Nasdaq more than tripled after he said that. But one similarity we have between now and then is we could be in the third or fourth innings of the AI boom, just like they were at that point of time in the internet boom. Like Dan Ives from Wedbush Security says, could be 9 p.m. in the AI party that's set to go on to 4 a.m. And that's certainly possible, just regardless of the stock market, looking at the actual spending on AI, the use cases, and I'll show you soon what the Walmart CEO said about AI could actually be driving some real productivity gains in the economy, helping to continually increase corporate margins. And there was a lot of people back in the mid-late 90s didn't like the valuation of tech stocks. They were shorting them. A lot of really smart guys blew up doing that. They were right in the end, but they were early, which is just as bad as being completely wrong. And so hypothetically, if you could go back in time to 1995, would you short tech stocks? I mean, just look at that huge rip they had over the last decade. Just looking at the Nasdaq 100 index here, back in 1985, it was 125. By 1995, gone up over 5x. Super stretched. Even Alan Greenspan, lots of media headlines telling us how overvalued, how bad things are. Fed's on the cusp of cutting rates. And sure, all that makes sense. However, like the old saying goes, bears sound smart, bulls make money. And the people that are making money back then were the momentum traders, were the trend followers, were the true believers, whatever you want to call it, because the Nasdaq index went on to appreciate for, like I said, another 5 years. Going from that index level of 500 back in 1995 all the way up to 4,800. Now, I'm not saying this is definitely going to happen again. Nobody knows exactly what's going to happen. I'm just saying it's possible with this AI boom, and who knows? It could even be bigger over the next 5 years. Anything's possible in markets, and that's why we pay attention to price action and trends. First and foremost, doesn't matter if it's a PE of 1,000, you can still make money. You're just obviously mindful of that. So when the structure of the market does change, you see breadth deteriorate, you see signs of a big technical top, the market goes underneath its 200-day moving averages, and it's coming from a spot of speculative bubble mania, huge valuations, then yes, you've got to be more careful and mindful of that, because the drawdowns from that spot can be very harsh, just like we saw after Nasdaq bubble burst. From that March 2000 high all the way down to late 2002, Nasdaq retreated 83%. And even in that time, big tech companies like Amazon were growing their revenue. They dropped even more. And that was a long bear market. Average bear market, just a bit over a year, around a year and a half. That went on for a couple of years. And sure, there was a lot of money lost in that period of time because a lot of people had joined the party late when they thought we were in a new paradigm. So this same pattern could very well play out again in today's market. But just getting back to the here and now in today's market, up until about a couple of months ago, the main concern of the market was inflation coming back. That's kind of subsided over the last couple of months, with the new fear being we're on the cusp of a recession. However, looking at the price action, a lot of markets, except for Fed fund futures and short-term bonds, just really not acting like we're on the cusp of a recession, just as corporate earnings and a lot of other leading economic indicators are not suggesting that either. Of course, things can quickly change. However, for the here and now, most things are holding up pretty good. And for sure, we could be doing a bull trap where markets have ripped up to new all-time highs like we were coming into July. They pull back and then we're bouncing. And you can pretty much see that pattern on the chart, the S&P 500. However, if we break out to new all-time highs, which I think would surprise a lot of people, that would kind of negate that pattern. And plus the long-term trend just hasn't even been broken either. We're also starting to see some optimism and enthusiasm come back into the market where good news is good again and stocks with a hot story are ripping up. We saw that today with AST Space Mobile, ripping up over 50% as their inaugural launch approaches. Said after the bell that its first 5 commercial satellites are on track to launch next month and serve as the largest ever communications arrays to be deployed commercially in low Earth orbit. And this is their website here. They're kind of similar to Starlink in that they use satellites, but Starlink provides complete like internet coverage from satellites where they use them in a more lower orbit as kind of like space towers, communicate with mobile networks. And they're looking to provide coverage all across the globe, just like Starlink, especially in hard to reach places. So it's definitely a cool story with plenty of potential. Space is definitely an area I'm interested in investing as a long-term secular trend, along with others like clean energy, cannabis, AI, synthetic biology, just to name a few. And like I was saying, the market just got super excited by it. Company doesn't even really have any revenue yet, but look at the tear it's been on this year. Having started trading at $5, here we are, after hours as I speak, $32. On this monster candle today, 75 million shares traded. Not typically the type of moves and stocks you see in a bear market. And so we're getting large hedge fund managers having reported their latest moves for the second quarter this week with their Form 13Fs. Getting a few more come in after I showed you guys a bunch yesterday. Seen a few of them pull out of tech stocks, some getting into Nike, and we've seen others like Paul Singer's Elliott Management, a new 6 million share stake, and Southwest Airlines. He's also been doubling down on Etsy and Liberty Broadband. However, what's interesting, just looking at Bank of America's Global Fund Managers survey, fund managers are still really defensively positioned here. We can see that they're overweight bonds, utilities, healthcare, telecoms, and staples, and they're underweight REITs, energy, discretionary, industrials, and tech. So a lot of fund managers still defensively positioned here, like they expect a recession, even though CEOs that run these companies are not really expecting the same thing. We got another taste of that today on the back of Walmart's earnings. Stock surging to new all-time highs after they said US sales rose 4.2% year over year in the most recent quarter, well ahead of Wall Street expectations of 3.5%. Also boosted its forecast for full-year sales growth to 3.75 to 4.75, up from 3 to 4. UBS retail analyst saying Walmart is on its own path. This is less about what is happening with the overall consumer environment because it has been challenging, and more about Walmart. So they're saying they're a bit of an outlier. We did get weaker than expected results from McDonald's, Home Depot, and Disney. But the CEO did say he's seen no significant change in consumer spending trends, saying both core and higher income customers continue to shop at Walmart. Also interesting today, thought I'd share with you guys, is what the CEO, Doug McMillon, said about AI, that they're finding tangible ways to leverage generative AI to improve the customer, member, and associate experience. They're using multiple large language models to accurately create or improve over 850 million pieces of data in the catalog. Without the use of generative AI, this work would have required nearly 100 times the current headcount to complete in the same amount of time. So that's a real material saving and productivity boost for a non-tech company like Walmart. And so generative AI will eventually touch every industry and business out there to improve productivity and efficiencies. And so this AI boom is really not going anywhere. If anything, it's accelerating. And the US and tech stocks stand to continue benefiting from that the most. And it'll spill out from other areas, from the actual hardware being produced into more software companies and consumer-facing apps and the back end of businesses, just like we're hearing Walmart CEO report. Again, the market was pretty pleased with the results after it was only a real modest beat on EPS. I think they liked the guidance. Stock up 6.5%, brand new all-time high. And you know it's election season when we've got a new global health emergency. Just kidding, guys. But we did have the World Health Organization just declare a monkeypox global health emergency. Got some health and vaccine stocks spiking up after the news. This is on the back of an outbreak of the viral infection from the Democratic Republic of Congo. It spread to neighboring countries. Monkeypox is a zoonotic disease that spreads from animals to humans with flu-like symptoms and pus-filled lesions on the body. Usually mild, it can be fatal in rare cases. I don't think we're going back into COVID. I think the World Health Organization, after being heavily criticized last time for playing it down initially, siding with China, I think they're a little more sensitive and getting ahead of the curve this time. So I don't think it's a real material risk. What the market's paying way more attention to is the surge in retail sales, increasing 1% in July, well ahead of expectations of a 0.3%. On an annual basis, sales rose 2.7%. June's retail sales were revised to a 0.2% decrease. Motor vehicles and parts saw the biggest increase, 3.6%, and this just came in really nicely in tandem with Walmart's results and just helping to lower some fears about the US economy and consumer. However, it's not all that great. When you look at the long-term average, is actually 4.63%, and when you adjust it for inflation, still came in negative territory, down 0.36%. Still got inflation slightly above where those growth and retail sales come in. So the consumer is still not great, just not in dire situation at the moment. And we saw that with weekly jobless claims falling. Economists were expecting 233,000 people to file for jobless claims last week. Came in 227,000, down from 234 the previous week. So that's another good sign for the jobs market. However, we saw industrial production come in a bit lower than expectations. That caused Goldman Sachs to lower their GDP tracking for Q3 to an annualized rate of 2.4%. still pretty healthy, well away from the negative reading it would have to be if we're already in a recession. So the fact is the US economy is still strong, still mostly employed, consumers are still spending, and we're just not seeing things fall off a cliff like a lot of people were shouting and screaming last Monday. And those that were out there crying for an emergency rate cut, say have a bit of egg on their face today, as that's starting to look more and more like a bit of a joke. And we've still got inflation coming down. We saw that with import prices easing. Price of goods coming into the economy only rising a low 1.6% in the 12 months ended in July. So the bond market kind of repricing all this. The yields jumping again today, kind of calming down a bit. So they're still really hanging their hat on the jobs report we'll get in a couple of weeks, start of September. Also the rhetoric we get from Jay Powell and Jackson Hole next Thursday and Friday as well play a key role. But we've even got one of the biggest bond traders in the world, PIMCO, saying they don't see a recession despite that big bond market signal. The 10-year, 2-year still look to being on a path to uninverting. However, could surprise us all and go back to inverted and continue this record long inversion, which would keep pushing out the date of an expected recession. And looks like Fed Fund futures are starting to agree with me again today. Big material change in their pricing. They're now saying there's a 3/4 chance the Fed will only cut 25 basis points in September, which, as you guys know, I've been calling for about 3 months now. And I'd put it at more chance they'll stay on hold than they'll cut 50 basis points. There's no real immediate signs of pain in the economy. The jobs report comes in better than expected. Who knows, they may stay on hold until after the election. But I still think it's probably 70% chance they'll cut 25 basis points, and I'd pretty much put the other 30% that they'll stay on hold. I don't think they're going to go 50 basis points. Stocks ripping up to new all-time highs. Retail sales growing. If unemployment came in at 4.3 or 4.2, I mean, what's the justification to go 50 basis points? We'd have to see some real deteriorating signs popping up soon for that to be justified. What's also good for inflation is a very tame price of crude oil, along with most other commodities as well, trading pretty weak these last couple of months. To get a little bounce today, doesn't seem really worried at all about what's going on in the Middle East. Probably more worried about demand from US consumers and China. As what's going on in Israel and Iran's kind of taking a back seat, kind of all expecting a response from Iran by now. Looks like they're not quite sure what to do, or they're building up for something bigger. Israel just dealt them a huge cyber attack yesterday on their central bank, froze their whole banking system. What looks like a bit of a preemptive attack, maybe trying to edge them on into doing something. However, their so-called supreme leader has warned of divine wrath if Iran backs down against Israel. So they must show a response. It's just how big a response do they give? Looks like they're still unsure about. However, when it comes to war, one of the biggest advantages you can have is the element of surprise, for which they have zero. Israel, along with the West, sitting right there at their doorstep, ready to respond the next second. And there's a look at the price action in crude oil, just peeling back a bit from its 50-day, and gold still hanging around all-time high. Even though that jump in retail sales and soft jobless claims showing some signs in the US economy, along with the jump up in the bond yields, could have been a reason for gold to pull back. However, it's still hovering up here, which I think is just pricing in some geopolitical risk. Also out in news today is the world's biggest steelmaker warning of a looming industry crisis that will outpace 2008's downturn. Saw some really sharp falls in commodities back then. They were ripping going into early 08, late 07. Commodity markets, emerging markets had a huge bull run back then. However, the rebound in the Chinese economy coming in lower than expected. Construction starts falling. Still got a lot of excess capacity in real estate, and that's showing up in excess steel supply, likely to keep some overhead pressure on iron ore and other related markets as well. Contrasting that is China's importing a record amount of silver, along with buying up gold, taking a sharp like to precious metals. Silver has been lagging behind gold recently. However, it outperformed today, slapping on almost 3%, creeping back towards the 50-day VWAP, still holding a nice uptrend from the start of the year. But just going out to a long-term monthly chart on silver futures, still well off the highs from 2011, got up to almost $50 an ounce. So still quite a lot of catching up to do. And just moving over to Bitcoin, which has been weak the last couple of weeks, correlated with the apparent rise in Kamala Harris's popularity. Part of the Trump trade being unwound, small caps and Bitcoin. Some mainstream media polls showing Harris out in the lead. However, if Trump wins, that could cause a big rip in Bitcoin when the market, as him along with his VP JD Vance, both pro crypto Bitcoin. Now so is Wall Street heavyweight Goldman Sachs, making its debut into the spot Bitcoin ETF market in the second quarter, purchasing almost $500 million worth of Bitcoin funds. Saw that in their latest 13F. We don't know if they got into Ethereum, so they just hit the market last month, so we won't know until the third quarter. 13Fs are filed, and this was on the back of news from last week, Morgan Stanley allowing their 15,000 advisors to recommend Bitcoin ETFs to their high net worth clients. So every month we get more and more Wall Street accepting crypto and investing in it. Should give it a structural tailwind, especially like I said, if the market starts pricing in a Trump-Vance White House, which we'll know in about 2.5 months. There's a look at the price action in Bitcoin, falling back there a bit today. My guess is the Biden administration has already started offloading some of their confiscated Bitcoin and may use that as a bit of a lever as well if it starts rallying, as I don't think they want it rallying going into the election, as that'll favor their opposition more. So they do have a bit of leverage here. However, it looks like Wall Street is happy to come in there and scoop them up. So we'll still be looking for this big 50,000 support level to hold over the coming weeks. And I thought I'd share with you guys today an interesting chart from all the way back in 1885. Before I talk about the technical analysis patterns, some of you may already know your stock market history. The railroad era, probably one of the greatest, if not the greatest, bull markets and booms out there. Probably the real first secular trend in stock markets. It was still pretty young. New York Stock Exchange was officially launched in 1792 under the buttonwood tree. Then in the 1800s saw the Industrial Revolution. Railroads a big part of that. Being able to move goods all across the country, opened up new markets, a lot of new entrepreneurs. And so the railroad boom went from the 1830s all the way up to the late 1880s. Kind of peaked out in the panic of 1893. A lot of them went bust over leverage, over capacity, too much speculation, etc., etc. So it went on for almost 70 years, that big boom and secular trend in railroads. And it's sort of interesting to share with you guys this chart, one of the big railroad stocks back then, Richmond and Danville. Chart starts here in June 1882, goes all the way to December 1886. It's a weekly chart, a little spotty. However, you see similar patterns that we still see to this day. You see breakups on volume, then the price consolidates, coils on low volume, breaks up again on high volume, consolidates on low volume, then rinses and repeats the same pattern. You see the same thing to this day, 140 years later. Principles of price action technical analysis don't change. It's not a perfect science, just the best way to visualize demand and supply in the market. And this is a logarithmic chart, so look at that move off the low of $32 in September 1884. 2 years later, it's ripping up to 160. They had their huge moves, bull markets, all that stuff back then. It's nothing new. And I have no doubt in 140 years from now, it'll still be the same. As long as humans can buy and sell stocks, there'll always be fear and greed and trend in financial market that you just don't simply see in a random string of data. And just getting back into the charts, here's a 5-day relative sector performance. See tech head and shoulders leading this bounce back here, along with consumer discretionary. Down the bottom, REITs, energy and utilities. Especially today, a real risk-on growth move out there. And like I said, just look at that market color, awash with green. Truly impressive, this bounce back, but even more impressive, surprising a lot of us, absolute crush in the VIX, volatility. If you are worried about volatility around the corner, one thing's for sure, it's a lot better to buy it when the VIX is at 15 versus 65. And just like I showed you guys last Friday, on the weekly charts of E-mini futures, these big hammer candle formations just look to be playing out as the textbooks describe them. And that looks to especially be the case in the Nikkei 225 Japanese stocks. Huge spike down, massive buy the dip. Same with Euro stocks and even a little bit with Chinese stocks. So wouldn't you not? We're only 120 points away from all-time highs on the S&P 500 cash index, and we've just reclaimed that advancing trend line I've had drawn in there. And like I've been saying, that peak and negative sentiment, people pile into put options, just set up a big max pain trade higher here. However, it could all come tumbling down if Jay Powell indicates to us next week in Jackson Hole that he may think about holding rates. I don't think the stock market would like that. Otherwise, the economy, corporate profits, all continuing to grow. Price action, breadth, volatility, bond market, dollar, and even global breadth all indicate risk on. Canada's TSX, UK FTSE, German DAX back above the 50, and the Aussie 200 as well. We've got some global equity breadth going on here. That wraps up the daily market review for this bullish Thursday. We'll see what the last day of the week brings us, and I'll break it all down again for you guys. Thanks very much for all your support, and I'll see you then. Cheers.